For this week's last edition of Targets in Focus, where we discuss FX forecast for some of the most traded currency pairs, I am joined by Aurelija Augulyte, macro strategist for Nordea Markets. Aurelija, thank you for joining me. Now, before we look at your chosen currency pairs, in your opinion, how has the market responded to events this week?
This week has been very dull in terms of market developments. I think that the key theme of this week behind has been retracing the euphoria-driven rallies, which we saw in the previous 2 weeks after ECB and Fed. So it's basically back to normal trends if you look at the euro-dollar, and also if you look at other markets broadly in general. The broad dollar sell-off has been slightly correcting. But other than that, the key event, the key expected event, was the release of European PMIs. The data came, very mixed, but didn't change the overall picture for the European economy. It's still contraction, yet some improvement in manufacturing PMIs. But that being said, the markets seem to have taken the message as a negative, because if you look at the European interest rate spreads to dollar, they have been trending down for the whole week, implying that there is expectation growing that ECB will cut the rates in the coming months, and that has been a key pressure for the euro.
The euro-pound fell to a fresh 5-day low yesterday of 0.79 as price continues to retreat from the recent 3-month high of above the 0.81 figure. I understand you're expecting the pair to fall back to these levels in the 6-month scale. What are your reasons for this?
I think that this recovery in euro broad-based, which we saw the past several weeks, a month, I think that it is not finished yet. Yes, things went exponential, but I think that the British pound is one of the currencies which is still lagging, and within a month's time has room to give up against the euro. That being said, and in a longer horizon, I think that the realization will come that still Europe has its growth problems, and the British economy has chances to grow at a higher rate. In particular, now that actually central bank is recognizing that maybe fiscal tightening is not the best strategy. Maybe we need to afford more pro-growth strategies. So even central bank is supporting that. So maybe the UK economy will get support from loosening this fiscal grip, and that will contribute to economic growth versus the euro areas.
The US dollar strengthened in tandem with the yen this week against the majority of its peers as demand for safety rose. Do you see this trend continuing?
Dollar yen has been very range bound over the past few months. It has been a very boring cross, I should say. And the problem with dollar yen is that basically it is little that Japanese central bank is able to influence. The key drivers still remain the global drivers, the risk on, risk off, and it is the central bank, the U.S. central bank Fed is actually affecting the cross more than the Japanese central bank. What they did this week, another round of easing barely lasted a few hours. The effect on dollar yen, so it will be the dollar rates and it will be the global risk-on trends, stock market trends, which will determine the dollar yen development in the near future. And when you look at those, like the key drivers, the rates spread, the interest rate spread, and the stock market index, like Nikkei, for example, you can clearly see that these have been trending slightly up over the recent few months, while dollar yen has been down. So I think that this recoupling will take place, and the dollar yen will be supported in the 1-month horizon. Maybe not. It will not go higher. It will remain below 79 in 1-month horizon, but still, it will show some upside potential. Longer run, 3 months, 6 months, we expect it to be at 80, 82. On the back of those expectations for those global trends, as I said, stock market to perform, and the U.S. yields to continue to slowly but surely grinding higher. And on top of that, we still have very, very weak Japanese growth momentum. Inflation, core inflation, bear at 0%, and central bank is targeting 1%. So they will come more and more easing. There will be more and more dovish signals, and central bank willing to intervene whenever dollar yen falls too much, too fast.
Swiss authorities reiterated their commitment to maintaining the 1.20 peg in the euro-Swiss franc. But what are your predictions for this pair?
I think that if you look over the recent few weeks, it is apparent that the euro-Swissie has been developing the euro-dollar way. That is, the broad euro strengthening has allowed the euro-Swissie to pick up. And that is, of course, based on overall relief in the markets and the sentiment changing for the positive side, which allowed the central bank to intervene less and less, and this lifted the euro-Swissie. That could continue, maybe not in the coming few days, but within a month, the euro-Swissie could easily be lifted to 122. Could remain there for some time. Yet, as we do expect the euro-dollar to trend lower at the end of the year and within 6-month horizon, it is very likely that the euro-Swissie will be back to those 120 to the floor, because the central bank is very clear in their communication saying that the economy is still weak. Today again saying that downside risks are still very high, and they will do whatever is needed to enforce the cap with utmost determination.
Aurelia, thank you so much for sharing your thoughts today. Sadly, that's all we have time for at the moment, but keep yourself up to date by clicking back to Dukascopy. Bye for now.